Imagine investing in stocks with the first 10 to 15% of losses covered. Buffer ETFs offer this protection. They promise cautious investors and retirees a shield during market crashes. In this video, we explain buffer ETFs, their workings, pros and cons, and if they truly allow you to invest without fear. Buffer ETFs, also defined outcome ETFs, limit losses and cap gains over a year. Think of them as a mix of index funds and insurance. For instance, a buffer ETF can track the S&P 500 with a 10% buffer. If the market falls, you lose nothing for that drop. However, your upside may be capped at 15%. If the S&P 500 rises 25%, you earn only 15% plus dividends. This trade-off appeals to those fearing a market crash, particularly near retirement. How is this achieved? Through options. Providers like Innovator and First Trust create these ETFs with varying monthly start dates. For example, buying an Innovator Jan 2025 S&P 500 buffer ETF means having a defined outcome. If the S&P drops 8%, you lose nothing. If it slides 20%, you lose only 10%. After the year, the ETF resets, setting new parameters. Buffer ETFs offer peace of mind, especially for near retirees. They cushion downturns and could have minimized losses during recent market crashes. However, in long bull runs, buffer ETF holders underperform compared to plain index investors. Understanding that buffer applies only for specific periods is key. Buying midway can alter protection and caps. Extreme market drops beyond the buffer still affect you. If the market drops by 30%, you lose around 20%. Buffer ETFs suit those hesitant to invest due to crash fears. They're ideal for retirees who need to avoid severe downturns. A portion of your equity exposure could be allocated to a buffer strategy, minimizing yearly downside. Financial advisors may use them to keep clients invested, knowing that worst-case losses are capped. Keep in mind the expense ratios and that caps depend on volatility. In high volatility conditions, options offer better caps. Variations exist, like ultra-buffer ETFs with higher protection but lower caps. Innovator even launched options with 100% buffer protection but lower caps, showing possibilities with options. Buffer ETFs customize risk-reward beyond traditional funds. They won't outperform a bull market but provide protection during a bear market. Used wisely, they can secure a portion of your assets, allowing you more risk elsewhere. In summary, buffer ETFs promise limited downside with some upside. They cater to conservative investors desiring market exposure and protection against big losses. For many, trading some upside for this safety is worthwhile. Explore buffer ETFs as a solution for cautious investing, especially in uncertain times.